Okay, this is actually it's my daughter here is helping out today. So my wife is doing some other things. So today we're going to talk about this issue of what happens when we're taxing labor, and we were talking about the excess burden of the tax, and so what we're going to do, just to sort of summarize here, we noted that if you only look at the supply curve itself, you could have a perfectly inelastic supply curve because the substitution effect and the income effects could move in opposite directions. And we're just, we've been talking about that many times in the past. And so let's just take a look at, again in figure 4, which reminds me, is there anybody that didn't get the handouts of the figures? Okay. Can you just come up, if you didn't get the handout for the figure, can you just come on up? Okay. So if we're looking at the incidence of a comprehensive tax on labor, and what we might do is take a look at, I think I can go ahead and do this before. If we look at figure 4 and we have a wage up here, we have it in dollars, and then what we have is the amount of labor here, right? We would have a regular demand curve for labor, and we have a supply curve. And of course, we have this equilibrium wage that is there on figure 4. And if we look at when you are receiving your income, right, you're receiving your labor income, part of it's going off in the tax. So for you, what you're really observing, this is what you're being paid, but what you're only getting is that amount there, right? That's the amount that you're getting paid. And so this is like, you can think of that as your gross wage here and your net wage there. So what's happening then is that for you, that's the wage that you're getting, right? I mean, in the net. And so what's the demand and supply for labor going to go from, what did I label that? Q star. And it's going to fall to QT. Okay, so notice that we now have a welfare loss, and again, what we've done is we've put the income compensated supply curve for labor, right? If we're doing excess burden, if all you're doing is looking at the incidence of the tax, then you don't have to worry about the excess burden. You don't have to worry about the compensated supply curve because you're just looking at what happens with the total amount that's being employed. But if we're looking at excess burden, right, just like we did with everything else, when you're looking at excess burden, you got to just look at the substitution effect. So if we look at the supply curve being the income compensated supply curve for labor, then what do you got? We're now going to go to Q star, right? Or excuse me, to QT rather than Q star. So all those units of labor between QT and Q star, they all have a value margin of product, right? This is what people are paying you, right? They're paying you the value margin of product. The value margin of product is larger than the opportunity cost of labor, right? So the value margin of product is greater than the opportunity cost. And so that is going to be then your welfare loss. And that's going to be, that's going to be the excess burden, right? So that's going to be the excess burden. This is the amount of welfare loss that's there because of the substitution effect, essentially, right? And so, so we've been doing this over and over again, but that's a very similar thing there. All right. So when we looked at the, in chapter 11, we looked at the case of a payroll tax collected from the workers, right? If you sort of remember back to when we were looking at that. And let's take a look at what happens if you, and of course we noted that it depends on the elasticity. What, the price, if you have perfectly inelastic supply, then if I put a tax on the workers, as we noted, it would all fall on the workers, right? So the more inelastic the supply, then the greater the burden that falls on the worker. So, but what we're going to look at here is we're going to look at what happens if you have a tax that's going to be paid by the employer, right? And essentially that's just because we looked at it from the one side. If the tax is paid by the worker, if we take it and look at the tax being paid by the employer. So if we look at figure 5, when we look at figure 5, what we'll do is we look at the demand and supply for labor. Okay, so demand and supply of labor. We got wage up here, and we got the amount of labor that's there. Well, now if the tax is paid by the employer, what's going to happen? You're going to reduce the demand for labor, right? Because they're going to have to pay the tax. So the demand for labor is going to fall by the amount of the tax, right? Because I don't care that I'm having to pay $15 to you, or whether I'm paying $12 to you and $3 to the Social Security Administration or whatever, right? So if we have here that the tax is being paid by the employer, what's going to happen is we're going to get a drop in the demand curve. Well, then what will happen? We'll go from, I labeled that L0, and now we'll have LT, right? And so again, this is the regular supply curve, right? Because we're not looking at excess burden here. We're just looking at what the incidence of the tax is. Well, now what's going to happen is that we're going to look at if we started out when I have this WE and WT. So now what's going to happen is you're going to get what? The wage is going to fall, right? So what's going to happen is the wage falls from WE to WT, and notice that we've got a reduction in the amount of labor hired, right? The hired goes down, and the wage falls, but it doesn't fall by the amount of the tax, right? That is the amount of the tax. That distance here, right, is the tax. So the wage is going to fall, but it's not going to fall by the amount of the tax. So part of the tax is going to be felt by the employer, and part of the tax is going to be felt by the employee. Again, how much of when we looked at the same thing when we were looking at a tax on a product, right? So the amount that is distributed between the amount that the employer is bearing the burden of the tax, and the amount that the employee is paying the tax, that amount will depend on the elasticity of supply and the elasticity of demand, right? I mean, it's just the same thing that we've been doing over and over again. So if you had a perfectly inelastic supply curve, if we just if we had a perfectly inelastic supply of labor, right? There'd be the demand, there's wage, there's labor. Well then, when the demand fell, to the, because of the tax being paid, what would happen is the wage would fall by the full amount of the tax, right? So if you had, and again, we did the same thing when we looked at tax on a good, where you had perfectly elastic demand for the good and perfectly elastic supply of the good. The share that's borne between of the payroll tax, the share of the payroll tax that's borne by the employer and the employee just depends on the elasticity of supply and the elasticity of demand. Now, notice that again, when we showed that when you put a tax on a good, it didn't matter whether you put the tax on the person that was selling the good or the tax on who was buying the good, right? It turns out the net effect is the same. You got the same deal here in that the net effect is the same whether I put the tax on the employer or I put the tax on the employee. And here, how does the payroll tax actually work? You pay half and the employer pays half. That's how it works, right? So just the Social Security tax by itself, you pay 6.2%, your employer pays 6.2%. But all that happens there is that when you get your paycheck, you could look and see, oh yeah, this is how much I paid. But how much of that is paid by you in the form of lower wages, or how much is paid by the employer in the terms of the tax, depends on that elasticity of supply. So it's really an empirical question about how much that is borne, how much of the payroll tax is borne by you as an employee, and how much is borne by the employers. If you look at the data, labor turns out to have a fairly inelastic supply, just informationally, right? So in just if we look at what's the empirical evidence, you have relatively inelastic supply. I don't write very well with these things. Okay? So what does it tell you? It tells you that the payroll tax, which is your Social Security plus your Medicare, that tax is being borne primarily by labor in terms of lower wages. Now, some things to think about though is that this elasticity of supply of labor may differ by demographic groups. So that, let's say the supply of labor for people that are under the age of 35 is pretty inelastic. But the supply of labor for people who are 50 and over, suppose that's fairly elastic. Well, then what you'd have is it will depend on the demographics, who would be bearing more of the tax, okay? So that if you think that people over the age of 50 tend to have relatively elastic supply, then more of that tax is going to be borne by the employer. Whereas if it's certain demographic groups have relatively, let's say you had working mothers, for example. They may have a relatively more elastic supply than does do prime age males. So just to think of doing again if you're looking for a research paper, when you're looking for your 8 to 10 page paper, but that's something that you wanted to think about when you're looking at that. All right. Now the other big component of the income tax that we'll be looking at is if you have a tax on interest income. So, and the question is, what does that do to savings, for example? And we could also look at what is this excess burden of a tax on interest income. So if you go to figure 6, again, we do the same thing, right? you're going to look at a trade-off between two things. We had the price of one good and all other goods, right? We did leisure, labor was the two trade-offs that we did with the tax on wages. If we put a tax on interest income, then you got to think of what are the two things that you're trading off. And the two things that you're trading off are, you're looking at future consumption and you're looking at current consumption. So the simplest thing is we're sort of looking at a two time period model, right? You can either consume today or you can consume in the future. And what we presume is that you have some indifference mapping, right? Some preferences between consumption today and consumption in the future. And so we would have an indifference curve, right? So indifference curves would look, like that, okay? So that, again, what do we, draw the indifference curve so it's got diminishing marginal returns, right? So that you have, if I'm giving up dollars in the future to get dollars today, I need a lot of dollars today to make up for a loss of the dollar in the future, right? So just like we have done with all our standard indifference curves. And then standard, what do? We're gonna have to have a budget line, right? And so we'll have a budget line and we'll have a tangency, okay? And at that tangency, what will happen? We'll have consumption today. I label that C1. And then I've got consumption in the future, and we'll call that C1. So there's some rate at which I can swap off consumption today and consumption in the future. If the interest rate was 0, then if I want to consume $1 worth of stuff next period, then I have to give up $1 today, right? But let's say I had a 20% interest. Then if I gave up $1 today, I could get $1.20 in the future, right? So the higher the interest rate, the steeper that thing's going to be, the more you're going to get. So what does a tax on interest do? A tax on interest moves that budget line in, right? Let's see that one. So if we tax interest, what's going to happen? I get less future consumption when I give up current consumption. So what's that going to do? Well, it's going to bring that budget line down, right? And, I mean, exactly the same thing that we did with leisure and income thing. And so what am I going to get? I'm going to get some new, so I'm going to have U0 and I'm going to get some U1 there. And so what's going to happen is I'm going to get C2 in the current period and less, I'm going to get, in this particular case, I get less consumption in the current period and less consumption in the future period, right? So C2 is smaller than C1 in both cases. Now, what am I also going to do? Okay, so that tells me what's going to happen. If I want to go, okay, what's the excess burden of this thing, right? Well, I got to look at the income and substitution effects, right? And so how do you do the income and substitution effect? If we're to do the income and substitution effect, what do you always do? I'm going to, I'm just going to draw a budget line, right, that's parallel. So I need to do a budget line that's parallel to the new budget line and make it tangent to the original indifference curve. All right, and we've done that a bunch of times. okay? It's just, again, what do? You set up a trade-off between two things. I impose the tax. I then take the new budget line of whatever I've done with the tax. I put it tangent to the original indifference curve to get rid of the income effect, and that gives me the substitution effect. So that gives you the substitution effect, okay? So, you know, I don't necessarily need to draw it here, but you get the idea, right? If I'm going to take this budget line and put it tangent to here, notice that again, what is the substitution effect? Always, the substitution effect is always going to have you buy, you're going to buy less future consumption and more current substitution. Because what happened? I made the price of the price of the price of future consumption just went up relative to current consumption. So effectively, that's what happened. So what I do is, if we do this, a substitution effect, well, when we do this, what's going to show you, right? Okay? The substitution effect will always have you basically buy more current consumption, right? And so that substitution effect is going to move you. Substitution effect is always going to move you this way. Again, because this thing's got a flatter slope, and I've drawn the indifference curve convex to the origin, it can't be that I get a tangency to the left. I've always got to get a tangency to the right. So by making future consumption more expensive relative to current consumption, what have I done? I've moved that. I'm going to have more current consumption. But now, what's the income effect, right? What you go from the substitution effect to the total effect. Moving from the substitution effect to the total effect, what will affect that? Is it a normal good or is it an inferior good, right? If we think about it, and then if I have current consumption is a normal good, so if current consumption is normal, then I've got less income, right? So I'll have less current consumption. So if it's normal, I'll have less current consumption, right? So they're going to be moving in opposite directions then. If it's a normal good, which we would, it'd be very hard to think of why all of your consumption as a group would be an inferior good, right? It's got to be a normal good. So current consumption's got to be a normal good. So what does that mean? It means that the current consumption and the income effect and the substitution effect are going to move in opposite directions, right? So the substitution effect and the income effect, they're going to move in opposite directions. So, are people going to save more, or are people going to save less if I put a tax on interest income? Well, the substitution effect will say, okay, now they're gonna save less, right? I put a tax on interest income, they're going to consume more today. But there's this income effect that says, hey, maybe they'll end up saving more. And you can sort of think about why that might happen. Suppose that you needed to have a certain amount of income in the future, right? The next period. Okay. Well, if I have less interest income coming in order to hit that target amount, what's got to happen? I got to have less consumption today in order to save to make my target in the future. So it could easily be that you got the income and substitution effects could offset one another. And it could be I mean, really, if you sort of think about it, it could be that if I were to tax interest income, I could increase savings, right? So the amount of what happens is, will again depend on will depend on what happens with the income and substitution effects. How much do they interact with one another? Now, again, if you look at figure 7, and if we look at figure 13.5 in the book, okay. Well, first of all, yeah.
So I'm wondering how having a really high rate of time preference would affect this picture. I'm wondering whether if you have a really high rate of time preference, it actually increases the chance that doing this might cause more savings, right? Because you have a steeper, steeper difference curve.
Yes, that's a very good point. What determines that what the difference curve looks like will depend on your rate of time preference. If you will gladly give me a hamburger today and you'll pay me on Tuesday, okay, like Wimpy, okay? Wimpy has he really wants the stuff right now, right? So that difference mapping between future consumption and present consumption, and let's say, you think that your kid, what if you thought your daughter was going to take care of you when you got older, and therefore you could just go ahead and consume today, right? Because I'm not worried about consumption, in the future, whatever, right? Because she's going to provide everything for me. So, in any event, but this rate of time preference determines what the shape of that indifference curve is, and of course, if you, in fact, it's probably worth just playing around with yourself. Draw it with a really steep indifference curve and draw it with really flat indifference curves, and see what happens, see what your results are. All right, that's a very good point. All right, if we're now looking at, again, excess burden, which we do, right? For every tax we've been looking at excess burden. Again, if we're looking at excess burden, what do we have to do? We have to look at the income compensated plot. Okay, so we got, what do I have? I said figure, is this figure 13.5 in the book. Okay, so then if we look at figure 7, here. We have if we have savings on the bottom axes, savings and investment, okay? And we put interest up here. What do we have? We're going to have a demand for savings, okay? So borrowers are out there trying to demand savings because they want to build a factory, or they, whatever they're going to do, some artificial intelligence, whatever they're going to do, some investment, right? So you have a demand for savings, right? So this is basically what the borrowers, right? The borrowers are the ones that are demanding it. And now what we have is we have a supply of savings, which is upward sloping, right? So we have a demand for savings, a supply of savings, and that if the market rate of interest is gonna fall, right? So, the return that you're getting is gonna fall. So you're looking at what you're gonna get, right? When you're deciding how much you're going to save, but you're not gonna, because the interest is being taxed, you're not getting that full amount, right? So the amount that you're gonna get, we can think of this as the net. What did I call that? Oh, I called it RN. Okay. So this is the return that you're getting gross, and this is RN. So that's the interest that you're receiving after the tax. Okay. So for you, when you're looking at here, this is the demand that for your savings. This is the supply of savings, and what you're getting is whatever the borrowers are giving to you. Now, notice that what's happening then is that where the amount of savings that you're willing to get is equal to this is what did I call that, S1 and S2. What's happened here is that you're going to have this amount of savings being provided at this interest rate, right? So this is, what did I call that, R2, and this was R1. So you're only going to get this amount after you've paid the tax. So if you're only getting that amount after you pay the tax, the supply of savings is going to be here. Now the market interest rate is going to be up here, right? Because you're getting that much when you sell your bond, okay? But after you got to pay the tax on the interest, you're only getting that amount. So what's going to happen is we're going to go to S2, right? And what's going to happen is that, did I label that one? Yeah, I labeled that RG. Yeah. Okay, so, let me see if I labeled this. Oh no, I labeled it RS. Okay, so what's going to happen is after we impose the tax, we're going to get S2 savings. So it fell from S1 fell to S2, okay? And what happened was that the market rate of interest has gone up. So we had the market rate went up, right? Sort of a standard thing here, right? So the market rate increased, but the market rate didn't go up by the amount of the tax, right? So market rate went up, but not by the amount of the tax. Okay? So that if we're looking at the incidence of a tax on interest, if I tax interest, what's going to happen? Borrowers are going to end up paying a higher interest rate, right? There's going to be less savings out there, and borrowers are going to pay a higher interest rate. Again, when we're looking at incidence, we just look at that supply curve for loanable funds, or supply curve for savings, and so we've got some of the burden of that tax on interest income is going to show up as borrowers are going to end up with a higher interest rate. Now, will it go up by the full amount of the tax? Well, it depends on it depends on what the supply of savings looks like, and it depends on what that demand curve looks like. But of course, the more inelastic the supply, right? The more the inelastic supply of savings, what's going to happen? You're going to end up with a higher interest rate. Okay, so some of that burden is going to be passed on to borrowers. So, again, if we look at excess burden, we'll look at that ABC triangle. Excess burden is that triangle ABC. Okay? Now, what did we have to assume to do that? We had to assume little income effect. Right? if you were to look, if there were a big income effect, what would you have to do? You'd have to use the income compensated supply curve for savings, right? So just as I have to look at the income compensated supply curve for labor, or I have to look at the income compensated demand curve for goods, etc. Right? I gotta, because I'm only wanting to look at the excess burden as the substitution effect. Because excess burden is I'm taking the amount of money out from you guys in terms of taxes. If I'm going to take out $1 trillion in taxes, all I want to do is, from an efficiency standpoint, I want to say, okay, let's take that amount out. Given we're going to take $1 trillion out, how can I make it so, as I said before, you don't splash the water around so much when I take a bucket of water out? So I just want to just look at the substitution effect. So if there's little income effect, then you can just use the regular supply curve. But of course, again, the excess burden depends on the elasticity of demand and supply for savings. Okay? So just as over and over again, right? The excess burden depends on those elasticities. And remember, when we were just talking about taxing a good itself, what did you want to do? You wanted to tax something that was perfectly inelastic in demand, right? That reduced excess burden to zero. And so the same thing here. You want to look at the elasticity of demand and supply. Okay. So any questions on this excess burden piece? All right. Now, there's another way that you might look at the a alternative way of looking at tax on interest earnings, and it's more of a Austrian school way of looking at things. Has anybody had anything on the Austrian business cycle? Okay, so what are they? You want to look at the demand and supply of loanable funds and the market interest rate there. Okay. So what we can do here is we could do a very similar thing. Is that we could look at the demand and supply of loanable funds. So again, if you look at Figure 8, this is just an alternative way of thinking about things. If we look at Figure 8. I could have a supply of loanable funds that looks like this, and a demand for loanable funds that looks like that. And again, this is the interest rate. Okay, and this is in dollars here. So if I start out with some equilibrium, demand and supply, we've got an equilibrium and we'll have, what did I label that? LF1. If what happens is I tax we can think of the tax being a tax that's paid by the supplier of loanable funds, right? It's the same idea, okay? So if we could think of, if you want to say that we're gonna look at the tax as a tax on the supply of loanable funds. Then what's going to happen is it's going to look like this, right? That is, in order to supply the same amount of loanable funds, what has to happen? I have to get the tax back, right? So as we move along that supply for loanable funds, the taxes, you can think of that as being the tax, the amount of the tax being paid by the supplier in terms of they're going to have to pay the tax on the interest. And so I'm going to do what? I'm going to go from LF1 to LF2, and what's going to happen? This is the amount of the tax, so we go from IE, and what did I label that? I said I1 and I2. Okay, so I1 to I2, and so what's going to happen? The interest rate's going to rise, but it's not going to rise by the full amount of the tax, right? Because this is the amount of the tax, the difference between this point along where we were at LF1. So what's going to happen? If I put a tax on interest income, again, you get the same result. That is, if I were to look at it from the demand and supply of global funds, it's sort of more Austrian way of looking at things, then I'm going to get an increase in the interest rate, but the interest rate isn't going to rise by the full amount of the tax. How much does it rise? Depends again on the elasticity of supply and the elasticity of demand. Now, notice that this isn't the only effect that you get here. That is, when we looked at, earlier we were talking about looking at general equilibrium analysis of a tax, right? We said, okay, if I tax hot dogs, what's that going to do? That's going to change the amount of hot dogs out there, but that's also going to change the price of hot dogs, and that's going to change demand for hot dog buns, right? It's going to shift those things around, and there's going to be less people working in the hot dog industry. There'll be less people working in the hot dog bun industry. Those people will move into other industries. That will affect the wages in the other industries, and it'll depend on how big the industry that you taxed is relative to the rest of the economy, et cetera. Right? So we had this idea that you need to think through a general equilibrium way of looking at it. You can think of that similarly here. If we were to think about it from a general equilibrium perspective, we want to think about if there's less investment, right? So let's say we find out that by taxing interest earnings, we have a big effect on the amount of investment out there. That is the amount of loanable funds, right? The amount of savings that goes out there. So if there's less savings, right, there's less investment. So if there's less investment, there's less capital stock, right? But if there's less capital stock, that's going to affect the value of the marginal product of labor, right? The value marginal product of labor depends on other things, but it also depends on the amount of capital that's out there. So now you have value marginal product of labor is going to go down, so wages will go down, right? But then you can just sort of keep thinking through here, right? If wages go down, then the supply curve for production of any good or service is going to shift to the right, right? If I lower if wages are falling, the marginal cost of production is going down, and so we ought to have more of the good being produced, right? So you can see the story can just keep, going on and on. Again, the point here is that if you are advising President Biden on whether you ought to increase the tax on interest earnings, okay? And I don't know if you've been following this, but there's certainly a discussion about that going on right now. Biden announced his program yesterday, I think. And so there'll be this whole discussion. If you were advising, the chairman of the House Appropriations Committee, or you're advising the Biden administration, you'd have to sort of think through these things and say, well, there isn't a big effect here, right? If there's not a big effect, then we can go ahead and do it here. But if we're going to have an effect, we got to think through. Here's all the unintended consequences that could happen, right? Sort of, those you had ECON 105, right? We read Mises's liberalism and talks about the unintended consequences of these things. So that's something that you need to think about, is that just if you were actually advising a policymaker, then you have to sort of think through, let's get an idea of what the elastic supply and elastic demand is. If we're looking at the elastic supply of savings, and how much of that is going to be passed on to borrowers, right? What I could do is I could raise the tax on interest earnings in order to what? In order to keep it so that these wealthy people don't have some, who are not paying their fair share. And remember, that's part of the deal, right? Is it equitable, right? Say the wealthy ought to be paying more, so I'm going to tax interest earnings, okay? But is that going to get passed on to borrowers? So that you are trying to borrow in order to get your car, so that you're lower socioeconomic status and you got to get a car to drive to your job. Now you got to pay higher interest in order to borrow to get your car, right? You got to think through that. And so that requires that you have some it's basically an empirical issue that of course could change over time. And then the last point I wanted to make was supply side economics. And Arthur Laffer, he sort of got to be famous for advising the Reagan administration on supply side economics. Did anybody know that Arthur Laffer was on campus? Yeah, he's doing some filming for one of the online courses that the college is going to be offering. And again, he's going to be on campus later on sometime to finish that out. So, but anyway, actually, if you come into my office, I actually have I happen to know him from back when I was in Congress, but he drew, the story is that he drew on a napkin, he drew his supply side thing on the napkin, so he drew it on a napkin for me and signed it. But anyway, if you come up to my office, you can see that. Bottom line is, the idea here is that by cutting taxes, what happens is you induce more work and more capital and more production, so you get greater production. And he argues that it's possible for the amount of increased economic output that occurs to generate enough tax revenue to offset the tax cuts that you put into place with the legislation, right? So anyway, if you at some point you might want to take a look at Arthur Laffer's supply side. If you wanted to delve into that a little bit more. But that's his idea, is that I'm thinking through, if I cut taxes, here's what's going to happen in terms of increased labor supply, increased supply of capital, through the fact that you get more savings, etc. All right. So that pretty much concludes the chapter here on, which is on the theory part. And then what we'll do on Friday is we will look at the next chapter, which is basically just going over the income tax, what it really looks like in the U.S. We're not going to do state income tax, but I put in the folder all the in your income tax portion of the folder. I have income tax forms. I added the 2020 income tax forms. So you might just want to look through those income tax forms, the different schedules, Schedule 1 and 2, and Schedule B, C, and D, and the 1040 form itself. So you might just want to take a look at that. I'm going to have office hours by Zoom tomorrow. I'm not going to come in tomorrow. So again, you know how to sign in my personal meeting ID and whatever, and so I'll do that between 9 and 11 tomorrow. Okay. All right? Yes?
When's the review session?
Okay, good point. The review session is on Sunday. Remember, I moved that. You guys, how many want it between 6 and 7:30? Okay, how many want it between 7:30 and 9? Okay, 6 to 7:30 is when you're going to do it. Okay, and the 105 class I'll do between 7:30 and 9. So 6 to 7:30 in here, Sundays when the review session. All right? Cool.